Hi, I'm Pete Andresen with Andresen and Associates. I just wanted to have a short update on the bond market. That's the real news in 2022. Stock market, as you'll see, is recovering rather nicely, partially. It's still negative for the year, but compared to where it was, it's up. The big news is in the bond markets. These are going to be opinions. They're educated opinions, but we don't really have the ability to foretell the future. Financial markets can go down, way down. That's why we're very cautious these days. My opinions in no way guarantee investment success. And hey, we're not perfect. But this is the big news. This is what I want to talk to you about. Look at 2022 over there, that big red line heading down. The worst bond market in decades because of rising interest rates from the Federal Reserve. I would argue that the freak show we've been seeing in the interest rates and in the bond markets is not this year. It's the past decade of constant stimulus, which has created an artificially dependent environment. But that's another video. So as of December 7th, 2022, the Vanguard S&P 500 stock market index fund is down 16.23%, which is bad, but it's not a catastrophic event. The NASDAQ stock market is down 29.44%. So that's interesting. The air is being let out of crypto, speculative tech stocks, the high risk stuff, which is where the air should be let out. So far, so good. The Vanguard long-term treasury fund is down 23.72%. We don't own that fund, but that is astonishing. If you look at this graph, you can see, this is from Schwab, you can see that since 1977, we haven't had a year like this. So it's pretty astonishing. We've seen in the allegedly low-risk bond market, and it is low risk overall, we've seen a big year of negative returns. And the reason is because we had inflation, obviously. Finally, all that stimulus that I regard as the true deviant behavior in the financial markets, all that stimulus that we've had since 2008 finally caught up to us. Now we've got, after COVID, we've got inflation. And so the Federal Reserve is hiking rates really fast, which actually is rather normal given the situation. But if you look, it's the fastest in modern times. Again, this is a Schwab graph, but look at that. Now, what's going on is there's too much cash in the system, too much cash in the economy, and the excess savings is being burned away. This graph by JP Morgan shows that there's too much cash out there, and that's why a recession hasn't started yet. And it may not start. That we may have a soft landing. I want to reiterate that we may have seen stock market bottoms, but that's not what history tells us. So if you look at this thing, we had major stimulus. If you look at that thin blue line, that pop we got was from savings from people getting helicopter money. Remember that? And so the result is that the bond markets are back to being interesting. You can now make a decent return. We're into treasuries that yield over 4% right now, short-term treasuries. And in the muni market, which is this graph, this is from Charles Schwab, muni market, the tax equivalent yield is 6.4%. That's tax equivalent. That means after you add back the taxes that would be taken off of a taxable bond. So it's interesting. Bonds are an investment again. The cost, however, has been a tremendously negative year, which we'll make up. Another result, we're seeing the dreaded inverted yield curve, and this is from gurufocus.com. An inverted yield curve has predicted the past 7 recessions. You look at that blue, that's the over on the left side, that's the treasury yield curve right now. And the bizarre part is that you can get more in terms of yield on a 1-year treasury than you can on a 30-year treasury. And that's that inversion. That always has resulted in a recession since the 1970s. We may have a soft landing. So far, the cash is burning off nicely. Thus, a recession is quite possible, but not certain in 2023. I'd say Europe first. But look at this as Vanguard. Okay, they're saying 90% odds of recession. If that happens, in a recession, interest rates go up, which they have, then they go down. So interest rates will go down. Bond values have gone down, but they're going to go up. The opposite of interest rates. Earnings will go down in a recession and then they'll improve. They haven't gone down yet. They're nice and strong thanks to all that savings. The stock market will go down, but then, and here's the key, the stock market will go up before earnings improve. It's going to mystically go up right in the middle of the recession, and everyone's going to say, what's that? Well, interest rates will be going down. People inside of the corporations represented by the stocks are going to see that earnings are up. They're going to be buying. So right when things are scary, the stock market will go up. Sometimes it double dips, but not very often. We don't really know what will happen. I want to emphasize that the bottom may be in way back there months ago. It's not entirely probable, though, because usually in recessions, earnings take a hit. And right now, the stock markets are not pricing in a decline in earnings. Building long-term success requires courage, and we're going to need it in 2023. I want to really pound on this. We're not seeing end of days stuff. We're not seeing 2008 hit the wall stuff. That could happen, but we're not seeing it. Investing carefully now is historically likely to create lasting value in 5 years and beyond, including in the bond market. But we don't want to rush, so patience. Patience pays off. I want to emphasize that right now. We're heading into the holiday season. Let's relax. Let's enjoy it. It's going to be an interesting 2023, but there's a light in the tunnel out there. Either that or it's an on-rushing train. But my feeling is we'll get through this just fine, and the bond market will repair itself. So thank you. Have a good December. Enjoy some of this rain we've been getting, and blessings.